Interest rates cannot stay this high forever. The United States can't service their own debt with treasuries over 4% for this long. And so at some point they will come down. And when they do, we feel like we're going to have a strong portfolio with strong NOI.
Zach Haptonstall. He's the CEO and co-founder of Rise 48 Equity and Rise 48 Communities. Since 2019, he has purchased over $1.725 billion worth of real estate, including 6,300 units. Currently have $1.2 billion in assets under management, 150 employees, best-selling author, and welcome, Zach, to Real Estate Hacking Live.
Yeah, no, thanks so much, Chris and Ben. Really appreciate you guys having me on here.
Really Absolutely. I've been following you, and we connected several months back. You've definitely had a pretty sharp rise, buying some nice properties, and you got unique perspective, especially on the multifamily side. So, I think you had an opportunity recently, and it was a high raise, and I was very curious. I was like, I wonder with this settlement, like how long is it going to take him to raise that? Yeah. And it was like 2 days later, I think it was like 50% subscribed or 70% subscribed. I forget what it was, but it was like, holy cow! Like, so how are you seeing? How are the conversations changing, if at all, with your limited partners or your passive investors for your deals? With them trying to beat inflation with real estate.
Yeah, great question, Chris. And yeah, I mean, like you mentioned, I think we've launched 4 different raises since July. So the last, 4 months or so. And surprisingly, the demand keeps getting stronger, and we've been kind of shocked that we were concerned that because of all the economic uncertainty, investors would be hesitant, not want to invest. But, I think you kind of hit the nail on the head is that, and so did Arian in the last segment. I think a lot of investors don't know where else to go, frankly. I mean, I think a lot of people don't trust the stock market anymore. And even if you're not the most savvy real estate investor and you're kind of newer, I think that the mainstream media and all the mainstream channels have really, hammered home the fact that inflation is real, right? And that it's bad to keep cash in your bank account. And so I think that people don't really trust the stock market. They don't trust crypto. They know they don't want to sit on cash. And so if they can find what they think is a conservative real estate investment in a strong market with an operator they trust, then I think, what we've seen is that a lot of investors feel confident. And even the last couple of months, we've just been getting flooded with referrals, from our current investors and previous investors referring their colleagues, friends, and family, because I think they're seeing, how stable these assets are. And so, I mean, in the short term, obviously interest rates have gone, up very quickly. We've hit our interest rate caps on every single deal now across our portfolio. And we've sold several deals, but right now we have 27 assets, a little over 5,000 units, all here in the Phoenix metro. And so, fundamentally, Chris, nothing has changed. Okay. So the population growth, the job growth is incredibly strong. We're having no issues hitting our pro forma rents. We have very strong leasing demand. And so, we're kind of full steam ahead with our business plans as far as renovating these units, increasing rents, which increases the NOI in the short term, because the interest rates are so volatile and the debt, is so uncertain. You've seen, short-term values dip in Phoenix and across the country. But the reality is that most of these deals are not even trading. You know what I mean? They're not even selling, because a lot of sellers are just like, you know what, I'm going to sit tight. And maybe next year is a better time to sell. So, I think Arian had a good point in the last segment. She was saying that the last 2 to 5 years, and like you said too, Chris, you could just, buy a deal and you're going to get organic appreciation. You're going to get cap rate compression. It makes you look really smart. Right. And we've been big benefactors of that as well. No doubt. But I think going forward, you're going to have to really, as far as multifamily is concerned, you're going to have to really execute on these business plans and stay on schedule and on budget so that you are increasing the rents and not relying on organic appreciation. And if you're doing that, you're increasing the NOI, you're increasing the value. And so it puts you in a good position where, right now we're going full speed ahead, renovating all of our properties so that, by the end of next year, if interest rates still haven't come down, and it doesn't make sense to sell these deals like in a year or two, like we've been doing traditionally. And by the way, these are always 5-year, conservative projections. If we can't sell a deal in a couple of years or less, well, we at least have increased the NOI so we can refinance, and get out of that short-term bridge loan and return some capital back to investors. And the thing is that these are very insulated, conservative types of investments. So, interest rates cannot stay this high forever. The United States can't service their own debt, with treasuries over 4% for this long. And so at some point they will come down. And when they do, we feel like we're going to have, a strong portfolio with strong NOI. And that's going to, cause cap rates to compress. You can sell for large values. And so yeah, I mean, I think that it's a great way to hedge against inflation just because, our rents keep going up. Values from an NOI perspective will go up. In the short term, the financial engineering of debt makes your short-term values dip just because people can't afford to pay as much with more expensive debt, but those will come back down.
Yeah, I mean, when there starts to be tremors in the market, it tends to be a flight to quality, and probably what you've seen is being able to demonstrate performance over the past few years, and what you've done. You've demonstrated that with your own investors, which it's had a trickle down effect within their networks, and is definitely helping. That also goes with the property itself. More maybe not necessarily Class A, but in certain I mean, you've definitely I think the last one or the last couple have been Class A. So there can be opportunities there, but it's just quality operators, quality assets. And that's what I'm looking for as a fund manager. I mean, it's not that I couldn't, and there's no circumstance I couldn't work with a newer, and I say newer, past few years, gotten into the business, syndicator, but really we'd prefer to work with folks that have operational experience, back to that flight to quality. Has the conversation changed at all? So even though some of the, you've had no problem raising, have you had different questions come up from some of the investors that you haven't really had to address as often in the past few years?
Yeah, no, absolutely. I mean, investors definitely want to know what's going on. So, a few months ago, we made a point and an emphasis, and we've always had pretty, and I don't do this, my partner Bikram and his team does this, our financial reporting, but we've always had pretty, comprehensive, detailed monthly investor reports. Well, we've stepped that up to even higher level and made those reports even more robust, where we're showing investors, here's the operational cash reserves that we have at the property. Here's our interest rate cap. We've run comprehensive stress tests on every deal, assuming that for the next 36 months, the interest rate at every asset goes to the maximum cap. Okay. And so it's as high as it can possibly be. And then we shave down NOI assumptions significantly, even from what it was in our original model, which was already stress tested, because we wanted to see, hey, are we ever going to get to the point where we have to do a cash call with these high interest rates? And we found that we're not going to have to do a cash call on any deal, even get close to that. And we want to tell investors and show them, hey, interest rates have gone up. We've hit the cap. We have operational reserves in place. So we've prepared for this as part of our initial stress test before we even bought the deal. And the plan is to continue to renovate the units. And so, our model, Chris, has always been that in our 5-year model with our stress test, since we started the company, we assume we're going to buy a deal. There's immediately going to be some type of economic downturn or recession, where organic rent growth is going to dip, vacancy is going to increase. We're going to hold through the recession, execute the plan by renovating 100% of the units, and then sell in year 5 to achieve the returns we're projecting to investors. That's always been the model. The last few years, in reality, what we've been doing is we'll blow through like 30 to 50% of the interiors in like 9 to 12 months. Then we hit the brakes on renovations and we stop early on purpose so that we have classic units or meat on the bone for the buyer, so that we can, prove out the concept, leave upside for them, sell the deal at a lower cap rate, and open up our buyer pool to more value add buyers. Well, now I can tell you the last few months, we've shifted our strategy back to what the original model is, because what's happened in Phoenix and across the country is that organic rent growth is normalizing and it's decelerating, after that crazy post-COVID surge we had. And when you have supply chain increases, logistically, it's very difficult for a lot of our competition in this market to actually execute on these renovations. Because in our space, we're in like the $30 to $150 million space. So most of our competition are like institutional equity, private equity, hedge funds, life insurance companies, and most of them are out of state. They're using third-party management, and they just can't simply execute on logistics of renovating all these units. And so with organic rent growth starting to slow down and the higher cost of renovations, a lot of these groups now, I've been talking to brokers, even the last few weeks, institutional brokers are telling me, these groups, they actually would prefer a mostly or a fully renovated 1980s value add deal, because they don't want the execution risk of having to renovate all those units, and they can't justify such big rental increases by doing it. They can't get the yield on cost. Okay.
Yeah.
Fortunately for us, we've been able to build out a very concentrated model here where we've got, property management in-house, construction management in-house. We control our supply chain. We buy all the materials. So we're renovating 70 to 100 units a month, same materials, same scope, same crews. And it's kind of a blueprint we can crank through. So my point is, Chris, that we now, like, there's a couple of deals that we bought last summer that we had stopped renovating because we had hit like 30 to 50%, leave meat on the bone, get them positioned to sell this year. Well, now interest rates go up. We're now firing back up the renovations with the goal of getting to like 80 to 100%, so that at least at the very worst, by the end of next year, we've increased the NOI significantly so we can qualify for a big refi, into like a 10-year Freddie Mac loan and take out the first lender and then, potentially return some capital back to investors if we can't sell. So that's kind of how we've adjusted, where we originally modeled the deals this way as part of our downside protection. We haven't had to do it the last few years, but I think that going forward, you're going to have to see operators across the country are going to separate themselves. And in order to perform, you will have to execute on these business plans.
Yeah. I mean, you've modeled, you've put the risk mitigation in the model, and then you've also provided the transparency, and then you also have the operational performance. And especially, I love, so from single family flips, like Arian was saying, it's like, boom, you need to get in and out. Don't diddle dolly on this thing, because you never know what's going to happen. And then beyond that, there's still operational cost every single day that cost you. And it's a concern that I have for some operators that maybe they didn't quite perform as quickly as they should, and now their bridge is coming up in the next 6-12 months. It could be a tough decision on whether they do a call, if they refi because they just don't have the NOI, or they just have to sell early and underperform, but at least come out on top, which is always good. But it takes a certain amount of humility to be able to do that and continue going forward. So in any case, well, man, you packed a lot of value in that short segment. So I appreciate having you on and look forward to talking with you again soon.
Yeah. Thanks so much, Chris. Appreciate it.